Okay. Good morning, everyone. So I was just checking. I suppose you have not received the material yet. It's not yet loaded on the app or on the website, but that's okay. That doesn't matter. So we'll take care of it in today's class. Good morning, Nidhi. Good morning. Morning, everyone. So we had started off with Ind AS 102 and we saw a couple of questions. We saw a whole lot of theory that we did in the previous class. So today we will be taking up a couple of questions that deal with uh, stock appreciation rights, and I had given you one question. You could not be doing it because you did not have the material in question. We'll do that the first thing now, and then we shall take up stock appreciation rights, accounting for that. Then we shall take accounting for group share based payments, and then equity with cash settled alternatives, and finally we shall close with uh, uh, market linked performance conditions and non-market linked performance condition, with a winding up on modification or cancellation of options. So that should be taking care of your standard today. Okay. So good morning, Viraj. Good morning, Asha. Good morning, Sriram. I hope you guys are all well. So we shall be starting our session, and I hope that you have your calculators, pens, papers in hand. Okay, so in the previous class, we saw what exactly we mean by share-based payments. The large focus will be on employee share-based payments in terms of computations, in terms of calculations, because we are going to have a lot of complexities in this area only. As far as non-employee related share-based payments are there, that is what you receive the service, you debit the service, you receive the asset or the material, you debit that, and then you will credit the share based, you will credit the equity share capital with what? Where you are receiving other than employee related services, you will debit the fair value of the asset or the service received, and credit will go to equity or premium as the case may be. But if it is an employee providing the service, you will always do the valuation based on the fair value of the equity instrument granted. The fair value as on which date? The fair value as at the grant date. Why? Because it is very difficult to measure the fair value of what an employee provides us. And because of that reason, we take it based on the fair value of the equity instruments which is issued to the employee as part of the share-based payment arrangement. Okay, so with this recap, we had done a couple of questions, and now we take the last question relating to employees, relating to stock options. Then we shall move on to the next set of problems. Okay. So this is a new question that has been introduced. Okay. It is actually there in your old syllabus, but it has only now come into the new syllabus in the RTP, I suppose. Okay, November 22 RTP. So it's a very important one. The following particulars in respect of stock options granted by a company are available. Okay. Number of employees covered 400. Nominal value per share is 100, exercise price is 125, and options per employee is 60. Shares offered were put in three groups. Group 1 was for 20% of shares offered with a vesting period of 1 year. Group 2 was for 40% of shares offered with a vesting period of 2 years. Group 3 was for 40% of shares offered with vesting period of 3 years. Okay. So that means what? See, any employee will say, I have to wait for 3 years. You please give me something that can be exercised immediately within 1 year or so, because today you don't have employees who live with the company for quite a long time. So employees will say, yaar kuch jaldi karo, so that we also get benefited. Aapka to kya ja raha hai? You're only issuing me the shares. So therefore, what companies do is they give an employee stock option plan, but they are vesting the options. They are, what you can say, spreading the vesting period. So in this case, options per employee is 60. So 60, I will split it into 20%, 40%, 40%. So this gives you how much? 12 options, 24 options, 24 options. Now, the first 20% will be vested after the end of 1 year. That means what? Even after 1 year, if employee resigns, can he exercise these 12 options? Answer is he can, because the vesting period of these 12 options is just 1 year. Suppose he continues for 2 years. That means he can exercise a further 24 options, because they also start getting vested in him. So therefore, he will now be able to exercise 12 from the first year, 24 from the second year. Third year he cannot exercise because he would not have served. And if you have served the entire period of 3 years, you will be able to exercise all the 60 options. Have you understood the concept of this vesting? Yes, please confirm. Have you understood the concept of this vesting? Yeah? Everyone, did you understand this vesting? How the vesting pattern is? Good morning, Namrata. Good morning, Panu. Yep, tell me. So we call this as a graded vesting. What do we call? We call it as a graded vesting. Okay, graded means, why you call it as graded? It is vesting over. It is as if one plan is broken down into 3 plans. You have 3 grades in which the vesting happens, 3 phases in which the vesting happens. Okay. So how do we do the accounting? Well, each and every vesting period, or each and every group 1, group 1, group 2, group 3. Each of these groups will be treated as separate plans. And then we do the accounting. Okay, so that is how you will be going to do the accounting. Okay, so fair value of option per share. On the grant date was 10 rupees for group 1, 12.5 for group 2, and 14 for group 3. Obviously, it will be different because fair value depends on the future, and it is based on an option pricing model like a binomial or a Black-Scholes-Merton model, whatever it is. So when that is the case, obviously it is going to depend on the future. And since the periods for vesting are different, the fair value for the 3 options is going to be different. The share value for the 3 options is going to be different. Okay, so don't say that the valuations should be the same. They will be different. Okay, so now coming to the actual positions. Position at the end of year 1, number of employees who have left the organization is 40. Okay, number of employees expected to leave in year 2 is 36. Number of employees expected to leave in year 3 is 34. And employees exercising the options in group 1 is 350. Okay, second year, employees who have left is 35. Estimate of employees to leave in year 3 is 30. Employees exercising options in group 2 is 319. Employees left at the end of third year is 28. Actually, employees at the end of the last vesting period is 297. And those who are exercising the options in group 3, 295. Options not exercised immediately were forfeited. Compute the expenses to recognize in each year and show the important accounts in the books of the company. Okay, so this is the question, a very important one, because though it is one question, you are having 6 questions inbuilt. The first plan is 1 question. The second plan is 2 sets of calculations, year 1 and year 2. The third plan is year 1, year 2, year 3. So 1 plus 2 plus 3, you'll have to do the calculations 6 times. Okay, so now let us start. Okay, now let us start. I will be asking you questions. Please ensure that you don't look at the solutions if possible. Okay, so you have the data with you. You have this data. You can just take a screenshot for your reference. Okay, for this number of employees, nominal value, exercise price, just take a screenshot of that and then we shall proceed further. Okay. Just take a quick screenshot. We have lots to do today. So I should be a little fast, but not at the cost of the concepts. Okay. So now tell me. Now you will tell me total shares under ESOP is 60. I explained this to you. Group 1, 12 shares are vesting at the end of year 1. Group 2, 24. Group 3, 24. Okay, fine. So now, can you do the calculation for the first year? Don't look at the answer. Can you do the calculation for the first year? Okay. I'm only asking for the first year. Okay. For the first year, can you do the workings for me? First year, group 1. First year, group 1 I am asking. Okay. I am asking group 1. Okay. Forget group 2 right now. Just group 1. Do the working. Yes. Quickly. Should not take time for this. Yes. I will work it out. I will work it out, but I need you to work this out for me. Okay. Yes. Come on. Try to work this. Group 1, what is the expense that I will recognize? Okay, so Janvi gave the answer, which is right. What about the others? Shriram, Panu, Namrata. What about the others? Nidhi, Viraj. Yes. Vidit. Lipika gave an answer. What about the others? Come on, quickly. Anybody else? You can just key in the figures. That is also fine. Okay, so let us start. Group 1, options vesting at end of year 1. At end of year 1. Okay. So number of employees, 400. But you should be in service at least for the first year. If you are not in service for the first year, तो भूल जाओ आपको ये ऑप्शन मिलने वाला नहीं है. So less number of employees left. How many have left? Sir, 40 have left. They have given a number of employees left is 40. Okay. So I am left with 360 employees. I am left with 360 employees. Okay. So multiplied by fair value. Sorry. Multiplied by number of options. How many? 12 per employee. Multiplied by fair value per option. This is how much in our question. This is fair value per option for group 1 is rupees 10. So into rupees 10. per option. So just do the multiplication. 360 into 12 into 10. So that gives you rupees 43,200. That gives you rupees 43,200. This is employee benefit expense for year 1, group 1. Acha, any pro rata allocation? Even if you do pro rata allocation, wo kya hoga? It will be into 1 by 1. It will be into 1 by 1. Because understand, the vesting period for options in group 1 is only 1 year. So 1 year has passed. So you will recognize the entire expense at the end of year 1. Did you understand? Yes, everyone, did you understand? Viraj, Lipika, did you follow? What about others? What about the others? Yes. What about the others? Did you follow? बोलो यार. Okay, fine. All of you have understood. Acha, is this the only plan that is there? Answer is no. There is, so group 1 ka story is over actually. Okay, we then look at what about the exercised options. Wo baad ki baat hai. We will then proceed to group 2. We will then proceed to group 2. Group 2, how many options? 24 options. 24 options. Vesting period of how many years? 2 years. Vesting period of 2 years. Okay. So now when I talk about this, I will have to do a calculation for year 1 and year 2. I will have to do a calculation for year 1 and year 2. Number of employees at beginning. How many were there? 400. Okay. Less left during the year. How many left? Sir, 40 left. Isme to there is no doubt in these facts. 360, 360. Okay. So number of employees at the end of the year is 360. That itself is the opening number of employees for year 2. Okay. So don't get confused. 360 came from where? It is this 360 only. Okay. Less number of employees expected to leave. Expected to leave. Why expected to leave? See, I told you, we have to do the working for the entire vesting period by estimating how many employees will remain in service at the end of the vesting period. So that is why number of employees expected to leave. Are you given the data? Yes, you are given the data. In year 2, 36 employees are expected to leave. Fair enough. So we shall take 36. We shall take 36. So you will be left with 360 minus 36, 324 employees. You will be left with 324 employees multiplied by number of options per employee. This is how many? 24 options. 24 options multiplied by fair value per option. This is in rupees. So that gives you how much in our question at the for the second group, the fair value is rupees 12.5. 12.5. So quickly multiply this and tell me what is the answer that you get. 324 into 24 into 12.5. So that gives you rupees 97,200. What is this? This is total employee benefit expense into pro rata. This is for 2 years. So I should take it for only 1 year. So 1 by 2. So that gives you how much? 97,200 divided by 2, 48,600. Less recognized earlier, which is 0. So this gives you 48,600. Expense for the year. Expense for the year. 48,600. Have you understood this? Have you understood this? Have you understood this? Okay, I think the document is uploaded on the web page, so you can just have a look. Okay, both the presentation as well as the assignments, both are uploaded, so you can download it. Okay. All right. Now coming to the second year, in the beginning, this is 360 employees. Is this estimate or actual? No, sir. This is actual. This is actual. Okay. 360 employees were there at the beginning. Number of employees who left during the year. How many left? Well, at the end of the year, you had 35 employees who actually left during the year. Okay. So I will subtract 35 from here. So 360 minus 35, we are left with 325. So this is actual number of employees. Don't get confused. ये कोई estimate नहीं है. This is actual employees left at the end of the second year. Actual employees left at the end of year 2. Number of employees expected to leave in year 3. It's not required because this is group 2. Options have vested. Check in the assignment section, Namrata. Check in the assignment section if it is there or not. Okay. Check in the assignment section if it is there. Okay. Just give me a minute. Yeah. Nothing. So you are actually left with 325. Number of options per employee 24. Fair value per option 12.5. So this comes to 325 into 24 into 12.5. So this comes to how much? This comes to 97,500. Both the years are completed. So at the end of year 2, the cumulative expense should be 97,500. How much did I recognize earlier? Sir, you recognized 48,600 earlier. So I subtract that and I will be left with 97,500 minus 48,600. So you will be left with 48,900. 48,900. Please confirm. Did you understand? Yes, Namrata got the thing right. Others, did you understand? Yes. Others, did you follow? Vidit, Shriram, Nidhi. Sir, how 48,600 can be deducted? No, Shriram, that is what I'm telling. See, this 43,200 is in respect of the options vesting at the end of year 1. This is in respect of group 1. These are the options which are already vested. See, my total plan is divided into 3 subdivisions or 3 sub-plans. Okay. This is 12 options. This is 24 options. This is 24 options. So 12 options have a vesting period of 1 year. 24 options have a vesting period of 1 plus 1, that is 2 years. The third category has a vesting period of 1 plus 1 plus 1. So when I do the first plan of 12 options, it is done. I don't have a second year for the first group of 12 options. These are already vested. Already vested. I cannot deduct this. These are, you can take it as 2 different plans. That is what I was telling when I said at the beginning of the problem, that treat them as 2 different plans. The first plan is having a vesting period of 1 year only. The second plan will start with accounting for year 1, and this expense will be deducted when I do the accounting for the second year. And now you will appreciate in the third plan, it will be 1 year which will be deducted when determining second year's expense. Second year's cumulative expense will be deducted when I'm determining expense for the end of year 3. So don't think that this expense should be deducted in this group. Don't think that this 1 year expense will be deducted in the second category, because the first category is already vested. It is done and dusted. Okay, so don't think that. In this case, there is no question of estimating a further vesting period. Okay, so I hope you understood that, Sriram. Yes, I hope everybody understood that. See, looking at the calculation is one thing, but understanding the concept is secondary. Okay, so I hope everyone understands the working. Okay, I hope everyone understands that. Okay, please confirm if you are clear with the concept of graded vesting. Yes. Sriram, did you follow? Exactly, Namrata. Group 1 has already vested, is already vested. I'm sorry. Okay. Sriram, did you follow? So, sir, what will be the expense to be recognized in the first year? That will be this expense plus this expense plus this expense. Expense to be recognized in year 2 is going to be this expense plus this expense, and expense for the third year is only going to be this one, is only going to be the third year. Is it okay? Yes, Sriram, not yet confirmed. All clear with it? Did you follow? Did everyone follow graded vesting? See, it's important that you understand. If you've not understood, I will explain again. Nidhi, did you follow? Panu, did you follow? I don't want you to say you followed 97,500 minus 48,600. I want you to tell why. I want you to understand why we have not deducted 43,200. Okay. I hope all of you understood that. Followed. Vidit has confirmed. Yes. 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 Yes, Namrata. Okay. Expected amount of expense to be deducted. Okay, it means for the second year, expected amount of expense to be deducted from actual amount of expense and net amount of expense to be recognized in year 2. Absolutely. That is what we have always done, right? If you look at the earlier questions, what did we do? See, look at the earlier question. Year one, I got the expense. Year two, I took the cumulative expense of 2 by 3. And from there, I deducted what was recognized in year one. So this is exactly the same way. Only thing why you may be getting confused right now is because you are seeing it from the lens of a single plan. Don't view it like that. View group 1 as one plan. Once it is done, it's done and dusted. Group 2 as one plan, account for it, do the computation independently. And group 3, view it as a separate plan. I'll do group 3 and I hope that you will be in a position to understand even clearer. Okay. Year 1, year 2, year 3. Number of employees at the beginning, 400. Less. This is group 3. Okay. 24 options. Okay. Number of employees at the beginning, less, left during the year, 40. So I am left with 360. Less, expected to leave when? In year 2, in year 3. Okay. In year 2, I expect 36 to leave. I expect 34 to leave. So 36, 34. So 360 minus 36 minus 34. So that gives you how much? 360 minus 36 minus 34. So I have to estimate the expense for the entire 3 years, for which I will have to estimate how many employees it is actually are actually getting the options vested. So I expect that 290 employees are actually going to get the options. So 290. Okay. Multiplied by number of options per employee. So this is 24, multiplied by fair value per option. This is rupees 14. So 290 into 24 into 14. So this gives you rupees 97,440 into pro rata. This is for a period of 3 years. So divide by 3. So rupees 32,480. Cumulative expense less recognized earlier. Nothing. This is the first year. So 32,480 expense for current year. Expense for current year. Now let us come to the second year. Second year, opening number of employees is the same, 360. There is no doubt here. Number of employees who have actually left. Number of employees left is 35, which is okay, fine. 35 have actually left. Okay, so I will be left with 325 employees. Expected to leave in year 2, not applicable, because end of year 2, I already have the number of employees who have actually left. So this is not applicable, but I can estimate how much will leave at the end of the third year, will leave in the next year. So number of employees expected to leave at the end of third year, it's getting revised to 30. So I will deduct 30. So you will be left with how much? I am deducting 30. So 325 minus 30. So that gives you how much? Well, that gives me 295, I suppose. 295. Number of options per employee 24. Fair value rupees 14. So this gives you 295 into 24 into 14. 99,120. 2 years have passed. So the total expense that should have been booked till now is 66,080. What am I going to deduct? What am I going to deduct? Will I deduct 43,200? Answer is no, I cannot. Those options have already vested. Will I deduct 48,000? Will I deduct this 48,600? Answer is no, because that is pertaining to a different group. What am I going to deduct is this estimate of 32,480, which I had booked earlier. Okay. So the expense that you will recognize is 32,480 deducted, and you will be left with 33,600. Expense for the year is 33,600. Very well. So now you move to the third year. Total number of employees at the beginning is actually 325. How many have actually left? 28 have left. So I am left with 297 employees. Do I need the number of employees expected? ये तो past data है, which is no longer required. Expected to leave at the end of year 3, that is also not required. I have the actual number. So I am left with how many? 297 employees, 24 rupees 14. So 297 into 24 into 14. 99,792. Full period has elapsed, so this gives me 99,792, and from here I will deduct 66,080. What is booked till the end of the second year? So this is my expense for the third year. 66,080 you subtract, so 33,712. Have you understood this part? Tushar is right, Namrata is right. Others, please confirm. Lipika, did you follow? Shriram, are you convinced? You appear to be in deep thought. Nidhi, did you follow? Viraj, did you follow? Vidit, did you follow? Janvi, did you get these answers? Asha, did you get the process? Yes. Did you get the process? Okay, fine. So Asha, Shriram has confirmed. Nidhi has confirmed. Yes. Okay. So everybody is done with the working. So we now come back to the answer. Okay. See, these are the expenses. 43,200 we got for group 1. Yes, sir. 48,600 we got for group 2 year 1. Yes. 32,480 we got for group 3 year 1. Answer is yes. Year 2 group 2 48,900. Year 2 group 3 is 33,600. And year 3 group 3 is 33,712. So we'll look at this J serial number later. Don't look at this right now. Don't look at this right now. Okay. Expenses to be booked for year 1 is going to be 43,200, 48,600 and 32,480. This is the total expense. Okay. So 43,200 plus 48,600 plus 32,480. This is the expense which will be booked at the end of year 1 for year 1. Year 2, it will be 48,900 plus 33,600, giving you total expense of 82,500. And year 3, it will be 33,712. So this is the expense which will be accounted. The entry will be employee benefit expense account debit to share-based payment reserve, and the employee benefit expense will ultimately be transferred to the profit and loss account. So this is the entry that will be followed. So you are having share-based payment reserve 124, 82,500, 33,712, which is transferred to the profit and loss account. So simple entry, yes. You are having a credit of employee compensation expenses in the share-based payment reserve. I am not yet come to the exercise. Okay, I am right now only in the vesting. Right now I have been only in the vesting. So ye ho gaya mera vesting. This is my vesting that is done. Okay, so now we look at the exercise. What are the conditions given for exercise? See, I'm not preparing the ledger accounts because one thing is it's a repetitive exercise. You can do it by yourselves. I'm just saving up on time. Okay, entries, you know, we just a matter of posting them in the accounts, which I'm sure you can do it. Okay, so options not exercised immediately on vesting were forfeited. Fine. So what the condition says is that there is no exercise period. The plan says that at the end of the vesting period, you have to immediately say, will you exercise or not? And if you don't exercise, then your options get forfeited immediately. Your options get forfeited immediately. Okay. So now let us look at the case. Group 1. When did the options vest, sir? At the end of year 1. How many exercised the options? Sir, 350 people exercised the options. 350 exercised the options. All right. How many employees the options had actually vested? It was 360. See, 400 was there in the beginning. 40 employees resigned. You are left with 360. So 360 left in whom the options had vested. Out of 360, 350 exercised. So therefore, 10 employees did not exercise the options. 10 employees did not exercise the options. Did you understand this 10 employees? This is nothing but 360 minus 350. 360 minus 350. So 10 employees did not exercise the options. So these 10 employees, we will have to show a lapse. We will have to show a lapse. And 350 employees exercised. That means they actually paid the money and got the shares. They paid the money and got the shares. So year 1, group 1. Each employee has, each option has an exercise price of 125. So this is what will come in the form of cash. You remember the journal entry. Cash bank account debit 125. Cash bank account debit 125. Value of service received. This is sitting in the SBP reserve. This is sitting in the SBP reserve. We have explained this already when we did the previous problems also. Okay, this is the fair value which you have already recognized. Employee benefit expense account debit to SBP reserve. So this is 10 rupees. Total consideration 135. Nominal value is 100. So you are left with 35 options. You are left with 35 options. Okay. Sorry, not 35 options. You are left with securities premium of, you are left with securities premium of 35 rupees per option. 35 per option. So now let us, what would be the lapsing entry? What would be the entry for lapse of these options? Entry for lapse and entry for exercise. Quickly, I'll do it. You can cross check. Group 1. Bank account debit. How many employees? 350. Each employee has 12 options. they will bring 125 rupees. Okay. So 325 into 12 into 350. So the bank account में कितना पैसा आएगा? 350 into 12 into 125. 5,25,000. Then to equity share capital. Against this, what will be the capital which will be credited? 350 employees, 12 into rupees 100. So 350 into 12 into 100. So that gives you how much? 350 into 12 into 100. 4,20,000, 4,20,000. To securities premium. 350 into 12 into rupees 35. 1,47,000. And what will be the SBP reserve debit? 350 into 1 second. Into 12 into rupees 10. So this gives you 42,000. 350 into 12 into 10. Have you understood the exercised entry? Have you understood the exercise entry or not? Yes. Okay. And what about the options which have lapsed? What about the options which have lapsed? 10 employees did not exercise. So that SBP reserve should be eliminated. So SBP reserve debit to retained earnings. Group 1 plan had a vesting period of 1 year only. They did not exercise. So therefore you will have to transfer the balance to retained earnings. 10 employees, 12 options, rupees 10. So this gives you how much? 1,200. 1,200. Have you understood this lapse? Have you understood the lapse entry? Have you understood the lapse entry? Yes, absolutely. SBP reserve to retained earnings. Did you get the entry for lapsing of the options? Calculations you guys understood? Yes. Just look at it now. 42,000 plus 1,200. My total debit to SBP reserve is how much? 43,200. And if you recollect, my expense for the first year was 43,200. That means, have I accounted for this entire 43,200? Yes. 42,000 went into the exercise of options. 1,200 went into the what you can say lapse of options. So 43,200 is accounted for. Hisab barabar. Okay, you can immediately cross check the figures. 43,200 बैठ गया उधर. Okay, all right. You will have to recognize the entry at the end of year 1, at the end of year 2, at the end of year 3 for employee benefit expense. For the lapsing and exercise of options, it will be at the end of the vesting period. That is right. At the end of the vesting period. For group 1, the vesting period ended at the end of year 1. So that is why you will have to recognize the exercise and lapse. So 43,200 fully adjusted SBP reserve. So now you look at the GL here. By bank account 5,25,000. This is the exercise options. We got this. To share capital 4,20,000, we got this. To securities premium 1,47,000, we got this. And to retained earnings 1,200, we got this as well. Okay, we got this as well. Is it okay? Yes or no? So we are left with a balance of 81,080. Now, what is this 81,080? Year 1 is fully adjusted. No, so this should be year 2 and year 3 balance. Year 2, my expense was 48,600. Group 2, year 1, sorry. Group 2, year 1, 48,600. Group 3, year 1, it is 32,480. So 48,600 plus 32,480 gives you 81,080. Yellow. So we have been absolutely correct in our workings, because now you can get a full picture of what is the balance in the SBP reserve, what is the utilization from the SBP reserve. We have cross-tallied everything and kept it for you. Did you understand? Yes. Sure. ये हो गया ग्रुप 1 ईयर 1 की कहानी. Yes. Did you follow? Okay, so we then proceed to the next year. SBP reserve opening balance brought forward 81,080. Opening balance brought forward 81,080. Okay, so now the exercise of options. This is the group 2 options. This is the group 2 options. So the workings will change, but entry will largely remain the same. So there only will be a change in the calculations. Okay. There will be a lapse also. So let us look at this now. Acha, how many employees have exercised the option? 319. 319. कितने employees थे? Sir, 325. कितनों ने exercise किया? 319. 325 were there in the beginning. 319 exercised. That means 6 employees did not exercise. 6 did not exercise. These options are going to get lapsed. These options are going to get lapsed. So 319, let us proceed and do the accounting. Sir, this will be 319 employees, each of them exercising 24 options and paying the price of 12.5 per option. So 319 into 24 into 12.5. So this gives you how much? Sorry, not 12.5. Exercise price is 125. My mistake. 9,57,000. 9,57,000. Equity capital 319 into 24 into rupees 10. No, is not 10, 100. Why am I missing 110? 7,65,600. What will be the premium? Well, exercise price is 125. This is 12.5, the service value. So total is 137.50. 100 is the face value. So 37.50 is the premium. So this is 319 into 24 into rupees 37.50. Two lakhs 87,100. 2,87,100. So what will be the SBP reserve? You can take it as a balancing figure. You can take it as a balancing figure. $95,700. Am I doing it right? Something is wrong. 319 into 24. Yes. 319 into 24 into 12.5. So 95,700 is your total SBP reserve debit. Is it okay? And then you have the lapse of options which is happening, which is 6 employees, So 6 into 24 into rupees 12.5. 6 into 24 into 12.5, 1,800. 1,800. And what is the total debit to SBP reserve? Total debit to SBP reserve in group 2 is 97,500, which happens to be, look at this, 97,500 total cumulative cost of options. See, you would have recognized SBP reserve year 1 48,600, year 2 48,900. So total is 97,500. So have I done the adjustment for the entire 97,500? Answer is yes. I have done the adjustment. Out of 97,500, 95,700 exercised the options and 1,800 went in respect of the options that have lapsed. So this is the adjustment entries. 9,57,765, 1,800, 2,87,100. So you will be left with a balance of 66,080. And what is the 66,080? This should be the balance in respect of group 3 options only. This should be balance in respect of group 3 options only, which it is 32,480. 32,480 plus 33,600 plus 33,600. Both these are of the third group only. So I have done the accounting correctly. And then in the final year, 295 employees have exercised the options. So now I'm not going to do the journal entry. It is simple now. 295 into 24 into 125, 8,85,000. 2 employees did not exercise. Out of 297, only 295 exercise. So 2 into 24 into 14, 672. Share capital 295 into 24 into 100. And how do I get the premium? 125 is the exercise price, 14 is the fair value, so 139 minus 100, so that gives you 39. So this comes to 7,08,000, 2,76,120, and total is 984,792 SBP reserve tallies. There won't be any balance in SBP reserve left at the end of year 3. Oof, have you understood the question and the answer? Everyone, have you understood the question and the answer? Yes. Please tell me. Clearly understood. Okay. Nidhi, did you follow, beta? Namrata, did you follow with it? Confirmed. What about the others? Viraj, Tushar, Asha, Panu, Namrata, Lipika. Okay, good. Good. So if you guys have understood this, then you will not be having any problem. So mark this particular question as an examination revision question. Okay. You do just this one question and that should take care of employee stock option plan. That should take care of employee stock option plan. You don't have to revise all the 7-8 questions. This one question is sufficient to take you through accounting for the vesting period as well as accounting for the exercise period. So mark this as a very important question. Okay. All right. So now let us proceed to the next concept. That is, we now pick up stock appreciation right, or what they call as share appreciation rights. Okay. So what do you mean by share appreciation rights? These are instruments where the company is not going to give shares to its employees, but it is going to give cash. Cash based on what? Based on the share prices. Okay, cash based on the share prices. So on the date of giving the stock appreciation right, there will be a particular fair value. There will be a particular fair value attached to it. And then depending on the movement in the share prices, the difference between the share price and the fair value is going to give you the exercise, is going to give you the amount that will be paid to the employee, is going to give you the amount that will be paid to the employee. So you are basing the payments to be made on the share prices, and that is why it is known as a share appreciation rights. That is why it is known as a share appreciation right. Okay. Now, in a stock appreciation right or a share appreciation right, what you are delivering. Now, please be careful. This is the only difference which is there. Otherwise, everything is the same like stock option plan. Okay, so that is why I'll not be taking much time on SAR. Just one difference is there. We do the problems, will be done with stock appreciation rights. Okay, see, employees share-based payments. You have ESOP, you have SAR, stock appreciation right. Now, in ESOP, what is the entity going to deliver? Sir, I'm going to deliver shares. What is the thing you are going to deliver in a SAR? Sir, I'm going to deliver cash. So when you are delivering shares, the credit would go where? Sir, the credit would go to SBP reserve, because this is a part of my equity. The employees to whom I'm giving the shares, they'll become shareholders in the future. So therefore, they are going to get a right in the residual interest. Residual interest means what? After liquidation, जो भी बचता है ना, I have to give a hissa of that to the employees also. So in terms of Ind AS 109, this becomes an equity item. Why equity item? Because you will give them shares or equity instruments. So where do I credit it? Sir, I credit it to SBP reserve. So where will you show SBP reserve? This will go and sit under the category of equity. This will go and sit under the category of equity. Whereas in the case of stock appreciation rights, I am not going to give you, what you can say, I am not going to give you equity. I have to preserve my holding. That's what the promoters say. If I give it to you, my holding will get diluted. So I have to preserve my equity. I'll give you cash based on the share prices. You ultimately need cash only ना. तू मेरे से खरीदेगा, मार्केट में बेचेगा तो भी कैश मिलेगा. इससे अच्छा मैं ही कैश दे दूं. So therefore, I am going to give you cash. I won't give you shares. So therefore, this is an obligation to deliver cash. Be careful with the words I'm using. This is an obligation to deliver cash. So this becomes a liability. This becomes a financial liability. तो इसको हम लोग बोलते हैं, we will be crediting it to SBP liability. We will be crediting it to share based payment liability. And this will go and sit under the liabilities side, not under equity, under external liabilities. Okay. Depending on current, non-current classification, you will do the working. Is it okay? Yes. Have you understood the difference? Yes. And finally, one last difference. SBP liability should be restated at end of every year. Should be restated at the end of each year. What do you mean by restated at the end of each year? You will be given fair values at the end of each year. So every year, the closing balance in the SBP liability should match that fair value. And then the difference will be adjusted in the profit and loss through employee benefit expense. Sir, क्या बोला? फिर से repeat करो. Whatever is the fair value at the end of each year, that will be the closing balance in the SBP liability. Zabardasti, yes, you will have to do that. Why you will have to do that? Because you have an obligation to deliver cash. And because you have an obligation to deliver cash, you have to show in your balance sheet what is the cash that is deliverable at the time of reporting. And that would be the fair value of the SAR as on the closing date, which will be given in every question to you. So therefore, you will have to restate it at the end of each year, and the difference, whatever is there between the opening liability and closing liability, that difference will ultimately be taken to the employee benefit expenses. It will be taken to the employee benefit expenses. All right. Whereas in the case of equity, we have done questions so far. Did we do any restatement? No, sir. We did not do any restatement. We did not do any restatement. Why we did not do any restatement? Are how can equity be restated? Have you ever heard equity getting restated? Own equity getting restated? Answer is no. You are always going to restate your investment in other entities' equity. But khud ka equity I cannot restate. It goes against my accounting principles. Reliance Industries shares are worth rupees 1 or 2 face value. But the market price is in the range of 2,800 to 3,000. So do you think Reliance Industries balance sheet should increase the value of their equity and state it at that value? Answer is no, you cannot. Why I cannot? It is against accounting principles. Why against principles? Because in your equity and reserves, only the result of operations is what should be accounted. You cannot account market movements and call it to be your own profits. So therefore, the market movements cannot be recognized in the books, cannot be recognized in the books. And that is why there is no restatement for SBP reserve. There is no restatement for SBP reserve. Is it okay? Did you follow the difference? Yes, between a SAR and a stock option plan. Is it clear? Yes. Is the material available? Could you please check? Could you please check? Just check if material is available. I'll just come in a minute. Okay, so SBP liability. SAR is a liability. SBP reserve, that is a stock option, is equity. Yeah. Now I have a question. Sir, is contract for service included in employee arrangement? No, of course not. Okay. All right. So you got the material. So that takes care of the material for you. That's uploaded. Okay. All right. So everyone, please download the material from the Board of Studies portal. Okay. You can have the material with you ready. Okay. All right. Fine. So now let us come to stock appreciation right questions. Okay. Let us come to stock appreciation right questions. All right. So now let us look at the questions and the solutions immediately. This should not take time. Only difference between stock appreciation rights and ESOPs is what? The restatement. Calculation wise, it's exactly the same. There is no difference. Only thing is fair value per option used to remain constant because we never restated it. Whereas fair value per stock appreciation right will change depending on the value at the end of each reporting period. That's the only change. Otherwise, everything is exactly the same. So look at the question which is there now. XYZ Limited issued 10,000 share appreciation rights, that is SARs, which vest immediately on 1st April 20x0. Vest immediately means what? This is in respect of services already provided. This is in respect of services already provided. So now I am compensating them. So that is okay. No problem. So we will book the expenses entirely. So 10,000 share appreciation rights. The SARs will be settled in cash. Even if they had not told this, it would mean that it is settled in cash. Using an option pricing model, at that date, it is estimated that the fair value of a SAR is rupees 95. So today the options have already, the SARs have already vested. So the entry that you will pass right now is employee benefit expenses account debit to SBP liability account. Sir, why liability? It is a SAR, it will be settled in cash. Why do I book the expense immediately? Because they have vested immediately. Okay. So the entry that you will pass right away on 1st April is going to be employee benefit expense account debit to SBP liability. Why do I do it? Because they have vested immediately. They have vested immediately. Okay. And that is why we are doing the accounting of the SAR liability on the first day itself. We are not doing 1/3, 2/3, 3/3, etc. वो सब कुछ भी नहीं है. Okay. Why? Because they have vested immediately. In all the previous questions that we did, they were vesting after 2 years, vesting after 3 years, vesting after a year. So the vesting activity used to happen later. Here it has happened right now, and that is why we booked the entire expense. So employee benefit expense account debit to SBP liability. The SAR can be exercised at any time up to 31st March X3. That means the lifespan of the stock appreciation right is 001, 0102, 0203. That is for a period of 3 years. That is for a period of 3 years. At the end of the period on 31st March X1, it is expected that 95% of employees will exercise the option. At the end of year 2, 92%. At the end of next year, 89% will be vested. Fair values at the end of each period are given below. You remember these fair values were never given in stock option plans because udhar ho hi nahi sakta. Even if it were to be given, you will have to ignore that because stock options will always be priced at the fair value on the grant date. And after that, we will never do a fair valuation in case of stock options because own equity is never revalued. So that is why no remeasurement of stock options. This is the rule that is there. Okay. It will change only when there is a modification, but modification will cover it later. This rule does not hold true for SBP liability, that is for SARS, because SARS represent an obligation to deliver cash, and therefore it is a liability, and therefore it should be stated at fair value, and therefore you will do a restatement at the end of every reporting period. So therefore, let us now look at the workings. Fair value at the time of vesting, we recorded 9,50,000. So this is fine. At the end of first year, you expect that 95% will exercise the SAR. So 95% will exercise. Fair value per option is 112. Total value of options expected to vest is 10,64,000 rupees. How did I get that? Well, I got that as 10,000 into 95% into rupees 112. So that gives 10,000 into 112 into 0.95. 10,64,000. Have you understood this part? Yes. Have you understood this? Did you understand this? Did you get this part? See, what I'm expecting is 95% of employees will exercise the option. That means at the end of the vesting, at the end of the period, when the SARs will actually be exercised. See, we can exercise what they have said. They can be exercised anytime up to 31st March 20X3. So today, as on 31st March X1, okay, fine. See, please summarize the question. See, 1st April 20X0, 31st March 20X3, बीच में X1, X2, 31st March X1, 31st March X2. On this day, you have issued 10,000 stock appreciation rights with a fair value of 950. Is it right? Yes, 10,000 into 95, sorry. So 9,50,000. 9,50,000. This is the position which is there opening. I hope this part you would have understood. Now, at the end of each year, these SARs can be exercised anytime till 31st March X3. They can be exercised anytime till 31st March X3. So when I come to the reporting date, 31st March X1, the company estimates that 95% will exercise the stock appreciation right. 95% will exercise. It is an estimate. And now on 31st March X1, the fair value of the SAR is 112. The fair value of the stock appreciation right is 112. So 10,000 SARs were issued. I am expecting only 95% to exercise, and the fair value of that is 112. The fair value of that is 112. So 10,000 into 95% into 112. The value of these SARs is going to be 10,64,000. Out of 10,64,000, यार मैंने खर्चा कितने का बुक किया? I have already booked an expense of 9,50,000. So therefore, the additional expense that you have to book is rupees 1,14,000. अरे have you understood this? ये समझा आपको? Did you understand this part? Step by step चलते हैं. Did you understand this? Have you understood this? Yes. All right. Fine. Now, they move to the next year, 31st March X2. They now expect that only 92% will exercise the options. And what is the fair value? 109. Fine. So now they expect 10,000 into 92% into 109. So therefore, 10,000 into 0.92 into 109. So this is 10,02,800. How much have you recognized earlier? Sir, earlier we had recognized 10,64,000. So therefore, you will now end up having to reverse 61,200. Is it possible to reverse? Absolutely, it is possible. It is based on your estimate. So therefore, it is possible to reverse. So you reverse 61,200. Okay. You reverse 61,200. And at the end of year 2, this is the position. At the end of year 3, 114, 89% will be vested only at the end of the third year. Okay. Fine. So we then proceed to the next one. 10,000 into 89% into rupees 114. Okay. $10,26,000. You have recognized 10 lakh. 1 second. 1 second. Sorry, my mistake. 10,000 into 0.89 into 114. So this comes to 10,14,600. From here, you had recognized 10,02,800 previously. So you will have to recognize an expense of 11,800. Have you understood the question? Yes. Did you understand this? Yep, that's right. Okay, that's right. Okay, so that is what they have done here. You can check. 1,14,000 recognize the expense EBE to SBP liability, reversal of 61,200 and then 11,800, and then you settle the options 10,14,600. So that is what they have done. So entry for the expense is EBE account debit, employee benefit expense account debit to SBP liability. You reverse, you pass the same entry, SBP liability to employee benefit expenses, and when you settle it, it will be SBP liability account debit to bank, SBP liability debit to bank. Okay. Have you guys understood this? Yes. Did you guys follow this part? बोलो यार. Yes. Did you follow? All right. Now, ये तो हो गया solution. But there are a couple of pointers in this question which I just draw your attention to. I have written to the institute also. Okay, I have written to the institute for changes in the study mat that they may have to do for this question. This is slightly, I won't say wrong, but it is a slightly confusing question. See, why it is confusing, let me tell you. Why it is confusing, let me tell you. First one, they have said vest immediately. All right. Whereas here, they will say finally 89% only will be vested at the end of the third year. So this is one confusion. This is one confusion that is there. You are saying they are vesting immediately. And in the last part, you are saying only 89% will be vesting. So that is something which is not exactly clear. Okay, so this is one part. We have told them to rectify this. Okay. The second part is, these are liabilities. These are liabilities. Okay. Equity के साथ हम छेड़खानी कर सकते थे. कैसे? We expect 95% to vest. We expect 80% to vest. We expect 97% to vest. This is liability. Liability मतलब क्या? You have to pay it in cash. If you have to pay it in cash, you cannot say that I expect 90% will vest, 95% will vest. कल को वो उठ के बोल सकता है मेरे को पूरा cash दे दो, all the 100% employees. तो ये cash का मामला, it is a liability. It is not a equity item कि आप equity shares issue करोगे. So therefore, the whole working of 95, 92 and 89 is a little ambiguous. Okay. Why institute did this, that also I will tell. The institute did this to explain to you the fact that the workings are exactly the same like that of employee stock option plans. But वो case नहीं हो सकता. It's not fitting in the logic that ये ultimately cash payment है. You are not going to issue shares. So it will be, you have to exercise some amount of conservatism here. Okay. At the end of the period, anybody who has not exercised that you reverse, you have that right to reverse. But today, when I do the accounting, I cannot estimate only 90% will vest and exercise, only 95% will vest. ये ना थोड़ा गड़बड़ है. This is going to be a little against our normal understanding, our normal logic. So to that extent, this question is a little bit inconsistent. So I would suggest कि you do this the way it is solved, but we are expecting this to be rectified in the coming module. Okay. We are expecting this to be rectified in the current module. Okay. So these inconsistencies will vanish at that point of time. Okay. So please take care of this. It will be done. But I hope you otherwise understood the concept. Okay. I hope you otherwise understood the concept. See, this stems from the treatment that we are having even in Ind AS 109. Okay. Whenever there is a liability, we generally recognize the full thing because it is a hanging sword on the company's head. Anybody can ask a liability amount कि भैया चलो मेरे को मेरे पैसे दे दो. So that point of time you have to pay. And you have to do a recognition of the full amount if it is genuinely possible. So here it is possible. So making an estimate does not seem to me personally to be correct. Okay, so that is the only thing which is there. Otherwise, as you can see, the workings are exactly the same like a stock option plan. Only thing is the fair value at each end of the year is changing, which should be changed, which is correct. Why it should be changed? Because why it should be changed? It should be changed because You are giving cash. You are not issuing equity. Okay. In exams, please follow this method. In exams, please follow what is done. Follow this solution only as of now. Okay. Because the question has to be modified for the answer to change. Okay. The question has to be modified. So I'm saying the question itself is not framed properly. There is inconsistency. So based on the question, the answer is right. You understand my point? The answer is not wrong. The answer is right based on how the question is framed. So when the question changes, the answer automatically will fall in place. Okay. So stick to the answer. Okay. Right now, if you read the question and the answer, both are consistent with each other. The question is not consistent with the concepts of Ind AS. That is what I'm trying to say. Okay. That is what I'm trying to say. Okay. So as of now, the answer is consistent with the question. So you stick to this answer. The question will get modified. That time the answer automatically will change. Okay. All right. So that is something you will have to keep in mind. Now, the next question, you will again do it by yourself. The same thing is there. Okay. 11,000. It is the same question. Vest immediately. SARs will be exercised settled in cash. This is the fair value expected 94% to vest, 91%, 85%. All this is what is given to you. Okay. So same question. I'm leaving this for homework. Okay. SAR, most of it will go as homework because that is something you will have to just go through the calculations. It's exactly the same, each question. Okay. All right. Next one. Okay, fine. We take this question. This one is an interesting one, although it is something you already know. Okay, so I don't have much to do in here. So this is the last SAR question that we do. It's an important one. Okay. An entity which follows the financial year as per the calendar year grants 1,000 share appreciation rights. So 1,000 SARs to each of the 40 employees. The SARs provide the employees with the right to receive on the date when the rights are exercised cash equal to the appreciation in the entity's share price since the grant date. All the rights vest on 31st December X6. They can be exercised during X7 and X8. Management estimates that at the grant date, the fair value of each appreciation right is 11. It estimates that overall 10% of the employees would be leaving during the 2-year period. The fair value of the SARs at each year end are shown below. You are given fair value at each end of the year. 10% of employees left before the end of 20X6, that is the 2-year period. So estimates were in line with actuals. On 31st December X7, when the intrinsic value of each SAR was rupees 6, was rupees 10, 6 employees exercised the options. Remaining 30 exercised the options at the end of 20X8. When the intrinsic value of each SAR was equal to the fair value of rupees 12. How much expense and liability to be recognized at the end of each year? Please pass the journal entries. Okay, fine. तो कितने एम्प्लॉय थे? Sir, 40 employees थे. We had 40 management personnel. So number of employees expected to satisfy, well, you thought that 10% will resign. You thought that 10% will resign. That means 36 would have exercised. It will vest for 36 employees. Okay. So here the question is different. Okay. Here the question is different. Here the question says that all the rights vest on 31st December X6. Be careful. The SARs are granted on 1st Jan X5 and they are vesting on 31st December X6. So if I have to plot a timeline, 1st January X5, 31st December X6, 31st December X8. Here is the grant. Here is the vest. And here is the last date for exercise. To exercise in this period, the options had vested immediately and they were estimating the vesting in the exercise period, which is not right. So therefore that was the inconsistent part. But yahan pe in this question, it's totally fine. It's totally correct. I am at the beginning of the grant date. On the grant date, I am estimating how many employees the SARs are going to vest. And at the end of the period, I am having how many it is actually vested. I am estimating in how many. Just confirm, is the video fine? Tushar is asking that the video, there is some error. There is no error. It's running on YouTube. That's what I can see. Yes. Others, please confirm. Video is fine, right? कोई error तो दिख नहीं रहा है. Just refresh your internet and have a look. Okay. All right. Fine. So now, this question is perfectly fine. It is estimating that 10% leave during the period from 1st Jan to 31st December. That is in the 2-year period. So which is perfectly fine, which is what you have to do, which is what is given in the standard also. In the previous question, I told you what was done, which is why it was inconsistent. Okay, so now let us start the solution. So you have vesting period, 31st December X5 year ending, 31st December X6 year ending. So what is this 36 and 36? Well, this is 40 into 90%. 10% expected to leave. So you are having 90% employees left. So that comes to 36. That comes to 36 employees. Okay. So now with that discussion, let us now proceed. Here you have actual number of employees. Okay. Expected to satisfy. This is expected to satisfy. And this is satisfied. Okay. December X6, I got the actual number. December X5, I had the expected number. Coincidentally, they are the same. They can never be the same. Coincidentally, they are. Multiplied by, what is the SAR? What is the SAR which is there? How many options? 1000 rights. Fair value 12 and 8. So let us look at the answer. 12 and 8. Multiplied by 1000 SARs. So 36 into 12 into 1000. 36 into 12 into 1000. So that gives you 4,32,000. And here it is 36 into 8 into 1000. So that gives you 2,88,000. This is half. This is 2 by 2. Since 2 years have expired. 2,16,000 already recognized. First year is it did not have a preceding year, so preceding year is 0, so 2,16,000, and then into 2 by 2, 2,88,000 minus 2,16,000, so you will be recognizing 72,000 rupees. Is this clear? Accounting till the vesting period, is it clear? Please tell me. Is the accounting in the vesting period clear to you? Is the determination of the figures in the vesting period clear, everyone? Okay. So what is the entry you will pass? Well, employee benefit expense account debit to SBP liability, and ultimately this expense is going to get transferred to the P&L. Okay. 2,16,000, 72,000, 72,000. Fairly simple, no doubts. Okay. So now let us proceed to the next part. Let us now proceed to the exercise period. In the exercise period, abhi zara dhyan se dekho. On 31st December X7, when the intrinsic value was rupees 10, What do you mean by intrinsic value? This is the difference between the current market price and the price on the grant date. Okay, this is the difference. 1 second, let me see the definition, whether I'm talking correctly or not. We had a definition of intrinsic value. It is a difference between current market price and exercise price. Yes, and exercise price. Okay, so this is what is your intrinsic value. Typically, this is the cash which will be paid. This is the cash which will be paid. Okay, so you can take that intrinsic value is nothing but the cash which will be paid. Yes. Cash which will be paid. You can understand it as that. Okay, because that is current market price, means movement in price minus your exercise price. The difference is what is the cash which is going to be paid. So 10 rupees is going to be paid. So therefore 6 employees into 10 rupees, usko 10 rupees milega, you will pay. So you will have to bring it down to 10 rupees or bring it up to 10 rupees. You had booked it at 8. 8 should now become 10. So 6 into 10, 60,000. This is what you are going to pay. So itne ka aapka liability hona chahiye. This much liability should exist in your books for the 6 employees. And for the 30 employees who have not exercised, you will have to restate. So now let us understand. I have 36 employees. Okay. I have 36 employees with me. Okay. Please understand this part carefully. This is critical for us to understand. 36,000 options. 36,000 options. Now, this is divided into 6 employees, 6,000 options, and 30 employees, 30,000 options. 30,000 options. Now, exercised on 31st December X7, exercised on 31st December X8, exercised on 31st December X8. Understand how the flow will happen. 6 employees on 31st December X7 will go to the company and say, look, the intrinsic value is 10. How did they calculate intrinsic value? They will look at current market price. They will look at the price mentioned in the document. The difference between that is 10 rupees. So they will say, yaar, time barabar hai, 10 rupees we should get on these shares. So let us go and exercise. Please remember, employees can never demand fair value क्योंकि employees को पता नहीं fair value क्या होता है. See, fair value is a complex exercise जिसमें you do whatever black shoals, it is based on option pricing. So option pricing models बेचारा employee क्या समझेगा? You give share options to the IT team in your company. वो सिर्फ आपके सामने आकर के बोलेंगे, please give me cash for this. Market price is so much. The price mentioned here is this much. The difference is 10 rupees. You give me 10 rupees per option. That is the essence of a stock appreciation right. The employee can never understand what is a fair value. That is for the company to recognize. So in respect of the 30 employees, we will restate it to fair value on 31st December X7. But in respect of the 6 employees, we will restate it to rupees 10 and pay it off. We will restate it to rupees 10 and pay it off. Please don't say that we will restate entire 36 employees to rupees 13. which is the fair value on that day. And then we will pay off rupees 10. Arey, how are you going to do that? You cannot do that, because then the liability is not going to be fully settled, which is not correct. When you are paying 10 rupees for these 6 employees, their liability is getting settled off. So therefore, the closing balance of the 6 employees SAR liability is going to be at rupees 10 only, because that is the essence of the stock appreciation right in place. Okay. So this will be 6 into 1000 into rupees 10. So this is rupees 60,000, which is what will be the closing balance on that day, which you are going to settle immediately. So as on that day, the final closing balance will be 0 in respect of these 6 employees. But in respect of these 30 employees, they did not opt for exercising. So what are you going to do? Well, you will value them at fair value. So 30 into 1000 into rupees, I think this is 113 or 13, sorry. This is 13 rupees. So fair enough. So into rupees 13. So 30,000 into 13, the closing value of this is going to be 3,90,000. The closing value of this is going to be 3,90,000. So in our question, this will be the closing value of the 30 employees options, that is SARS, 3,90,000, and in respect of these 6 employees, the value is going to be 60,000. So what should be the total expenditure to be booked cumulatively? 4,50,000, out of which you have already recognized 2,88,000. You have already recognized 2,88,000. 4,50,000 total cumulative expense, 2,88,000 already recognized. So balance to be recognized is going to be 1,62,000. Balance to be recognized is going to be 1,62,000. Have you understood this part clearly? Please confirm. Have you understood this part clearly? Please confirm. Yes. Did you understand this? Did you understand this? Tushar, Viraj, Harita, Nidhi. Viraj, Asha, Panu, Shriram, Vidit. Clear. Okay. Nidhi confirmed. Janvi has Nidhi did not confirm. Janvi has confirmed. Tushar is saying it's not clear. Okay. See, I had 36 employees. Now please pay attention. I'm explaining the last time. Okay. I had 36 employees. Yes. How 36? Well, I had 40 employees to whom the SARs were issued. And with these 40 employees, four employees actually resigned. So I'm left with 36 employees. This is as on which date? As on 31st December X6. This is the actual position. So 36,000 options, or I should say 36,000 stock appreciation rights existed. Stock appreciation rights existed. Now, out of these 36,000, 6,000 are getting exercised on 31st December X7. And the remaining are getting exercised on 31st December X8. So now the question is, how do I do the restatement here? 31st December X7. I have fair value of rupees 13 and I have an intrinsic value of rupees 10. What is intrinsic value? Difference between current market price and exercise price. So when the employee wants to exercise his stock appreciation right, all he has to do is go to the NSE, look at the pricing of his company, and then go and tell, look, in the document you told exercise price is so much. Today the market price is so much. The gap is 10 rupees. I want to exercise my option. La deo mere ko 10 rupees per option. So this is known as an intrinsic value. Intrinsic value comes into picture only when the option is getting settled. Only when the stock appreciation right is being paid off. Otherwise, intrinsic value has no relevance absolutely in doing the accounting. No relevance. Okay. So, for these 6 employees, they are exercising. So, therefore, 10 into 6,000, you will value this at 60,000. You will not take it as rupees 13 because you are not going to pay them 13. You are going to pay them 10 rupees. Whereas the remaining 30 employees, you are not paying them, no. So keep it at fair value of rupees 13. So 30,000 into 13, 3,90,000 comes to be the value of your employees, SAR, who have not exercised. So what will be the total closing balance? Well, this is going to be 4,50,000. Sir, 60 pay karoge? Haan baba, agreed. You will pay 60. But just before the payment, the balance is 4,50,000. Out of that, last year's closing balance was 2,88,000. So the net movement that will be recorded now through the P&L is 1,62,000. Is 1,62,000. Okay. So this is how you will do the booking. So coming back to our question, 4,50,000 minus 288, 1,62,000. Tushar, please confirm that you understood. So now the entry that is going to be passed will be employee benefit expense account debit to SBP liability 1,62,000, and then you are going to pay the SBP liability to bank account. You will be paying those 6 employees 60,000 rupees. So they are out of this plan now. Now you have the remaining 30 employees. What do I do with these 30 employees? Well, in the end, what is happening is you will ultimately make the payment of rupees 12 because that is what they have given. Intrinsic value was equal to the fair value of rupees. Intrinsic value was equal to the fair value of rupees 12. So ultimately it's going to get settled at 12. So we do the accounting at 12. So 30 into 12, 3,60,000. You had booked an expense of 3,90,000. So net reversal will be 30,000. So entry will be SBP liability account debit to employee benefit expenses, and SBP liability ultimately settled for 3,60,000. Ultimately settled for 3,60,000. Is it okay? This is for the 30 employees. All right. So that takes care of your stock appreciation rights. That takes care of your stock appreciation rights. Okay, fine. All right. Now let us move on to some quick concepts. 2-3 small concepts are there. All clear? Nidhi confirmed. Tushar also confirmed. Harita confirmed. Yes. Okay, fine. So then let us move on to the next one. What do we do? Do we do SAR? SAR is done. Stock options are done. We shall now pick up. Okay. Now we shall pick up an interesting concept. We shall now pick up an interesting concept, something which you haven't done in your intermediate. Something which you haven't done in your intermediate. Okay. Something which you haven't done in your intermediate. Should not take time. It's very simple. Khali 2 journal entries hai. This is group share-based payments. Group SBPs. Okay, this is group SBPs. Now, how do we do this accounting for group SBPs? Let me give you an example. Two examples I will give you. You should be able to understand. Okay. Jio Platforms wants to give a stock option plan to its employees. Jio Platforms wants to give a stock option plan to its employees. Okay. It goes to the employees and tell, देखो, we will give you our shares for a stock option plan. Employee भी बोल रहे, क्या मजाक करते हो सर, आपका शेयर तो अनलिस्टेड है, हम चाह करके भी इसको कहाँ बेचेंगे, आपको लगेगा कि आपने कुछ दिया है, हमको नहीं लगेगा कि आपने कुछ दिया. You feel you would have given something to us. We do not feel you have given anything to us, because what you are giving virtually has no utility for us. We cannot go running to find a buyer for Jio Platform shares. Okay. So employees से कोई फायदा नहीं होगा. हाँ, employees will tell one thing. अगर आप हमें Reliance Industries का शेयर दे दोगे, if you give me the shares of Reliance Industries Limited, then we will be happy. Okay, so did you understand the game? Yes, employees are of Jio Platforms, but Reliance Industries is going to issue equity shares to the employees of Jio Platforms. इसको बोलते हैं हम group share based payments. We call this as group share based payments. So in this case, the parent company is going to issue the shares to the employees of the subsidiary. So you can just draw this chart. Group SBP. So first case, parent issues shares in share-based payment plan of subsidiary. P means parent. So Reliance is issuing shares in the share-based payment plan of the subsidiary. So two activities are happening for which we need journal entries. Books of P, books of S. Books of P and books of S, that is books of Reliance and books of Jio Platforms. Well, the employees are providing services to Jio Platforms. So the expense will be booked in the subsidiary. So here I will be having employee benefit expense debit. So this is the entry that will be passed by debiting the employee benefit expense. But can subsidiary recognize SBP reserve? Answer is no, sir. You cannot. Because SBP reserve kiska banega? SBP reserve will be recorded by Reliance, because Reliance is going to issue the equity instruments in future. तो सर यहाँ पे होगा 2SBP reserve. 2SBP reserve. The problem arises now, sir, debit किसको करे और इधर credit किसको करे? This is the problem that arises. Reliance will debit what? Jio will credit what? So the standard tells, view it as a substance over form. If Reliance is paying the liability of S, see, ultimately kya kar raha hai? What is Reliance doing? Employees have worked for Jio. So Reliance is paying off the liability of that, albeit it could be by issuing equity shares. But important part is it is paying off the liability of the subsidiary. So therefore, can I say that this is nothing but introduction of an investment in the subsidiary? If I look at substance over form, can I not say that this is investment in the subsidiary? Yes or no? How can you assume salary value of services, Namita? Tell me. Today you have an employee who is providing you services. Suppose tomorrow you are an employee, you join a company, you are doing financial reporting services one day. The next day you are doing taxation services. The third day you are doing GST. The fourth day you are again preparing financial statements. The fifth day you are doing something else. So now you tell me, can I find a comparable profile of what Namita does in another entity? Is it appropriate to find? You are working, suppose, in a company like Reliance Industries Limited, jiska turnover is say about 20 to 30,000 crores. All sub le deke, do you think you can find an employee who is working in a similar organization with a turnover of 20,000 crores? Do you think it is possible to find another employee doing the same job as you? नहीं हो सकता. सर मैं सेम ऑर्गेनाइजेशन में ढूंढूं तो नहीं ढूंढ सकते. In your own organization, you cannot have two employees carrying on the same job roles. Why will they hire two employees for the same job roles? Not possible. अच्छा, तो फिर I will look in the other organization. Other organization has its own set of standard operating procedures, own controls, own reporting systems. Everything is same. So each employee is unique to the services that he or she provides. And that is why we never go into doing the fair valuation of employee services. We would prefer to do the reverse. That is, we take the fair valuation of the shares. We take the fair valuation of the shares and not the services of the employee. Okay. So now Reliance Industries issues the shares. We are not issuing ESOPs here. See, employees of Jio, what are they going to do with shares of Jio platforms? They will say your shares are not listed of Reliance Industries Limited. You give us the shares of Reliance Industries Limited. So Reliance gives the shares to the employees of Jio for the services rendered by the employees to Jio platforms. तो इसको हम लोग बोलते हैं group share based payments. So what will be the entry for this? What will be the entry? This is like an investment. So the entry that will be passed by Reliance is investment in subsidiary debit. Investment in subsidiary debit to SBP reserve. To SBP reserve. And what entry will the subsidiary pass? Well, subsidiary will pass to capital contribution of parent. It will just go and sit under other equity. It will just go and sit under other equity. See, other equity, don't take it like it has to be only equity shares, equity shares, equity shares. ऐसा कुछ भी नहीं है. It will be just an item like your retained earnings, other reserves, etc. वैसे ही एक रहेगा capital contribution from the parent. Okay, this will go and sit under other equity. Other equity. तो इसको हम लोग बोलते हैं group share based payment plans. We call this as the group share based payment plans. Okay, first part. Sir, can we have the second part also? Can we have the second part also? एक second यार, कहाँ गया वो? Yeah, can we have the second part also? That is S issues shares in SBP plan of parent. हाँ जी बिल्कुल, क्यों नहीं हो सकता? Definitely हो सकता है. Just replace these companies. Just replace these companies by Tata Sons and TCS. Tata Sons and TCS. So the employees of Tata Sons have served Tata Sons. Tata Sons says we will give you our shares. Employees बोलेंगे यार आपके शेयर तो मैं किधर बेच भी नहीं सकता. It is an unlisted share. And एक तो उसका value is so costly, not easily tradable. So कोई फायदा नहीं है. So what Tata Sons will tell, it will order TCS कि look, these employees are working for us. Because they are working for us, you issue the shares. You issue the shares to these employees. So now what will be the journal entry? The journal entry will be books of P, books of S. The journal entry here will be who is giving services? Employees of the parent. So here the entry will be Books of P, employee benefit expense, debit. Employee benefit expense, debit. Books of S, what are you going to credit? To SBP reserve. To SBP reserve. So this is what is the entry. Half entry. So full entry क्या होगा? What will be the full entry? See, S is issuing something on the parent's instructions. S is issuing something on the parent's instructions. That means what? Parent is ordering S to distribute something. Parent is ordering subsidiary to distribute something. Distribute means dividend. और कुछ distribute हो ही नहीं सकता है. What comes back? See, employees have served the parent. The subsidiary is paying it. Just think that if the parent did not have cash, what would the parent have done? Parent would say, chalo subsidiary, you are cash rich, issue dividends, it will get the cash and then pay the liability. In this case, the employees do not want cash. They want shares of the subsidiary. So I will order the subsidiary ki chal beta tu apna share issue kar de. So this is nothing but in substance a dividend distribution from subsidiary to the parent. So the entry that will be passed here is dividend distributed, debit. And here it will be to dividend income. To dividend income. Okay. So this is what will be done in the event of a group share based payment plan. Of a group share based payment plan. Okay. So simple concept. Nothing very difficult, nothing rocket science. Okay. Only thing is it is new. You had not studied this earlier. Have you understood this part? Bolo yaar, please tell me. Have you understood this? Yes. Namita, did you understand your queries? Yes. Namita, did you follow? I gave answers to both your queries. Okay. All right. Namrata, Harita, Tushar, Nidhi, Vidit, Shriram, Panu, Asha, did you guys follow? Yes. Have you understood? Yes. All right. Janvi also has confirmed. Okay, fine. Yes. Okay. So you have a couple of small questions on group SBPS. So just go through these questions. Same concept is just testing your journal entries. तो कुछ करने की जरूरत नहीं है मुझे because you know the whole process now. So just look at the journal entries and do the booking. Okay. So I'm leaving these two small questions for homework. Calculation part remains the same. It's just that you're passing different entries. That's it. Okay. So group share based payments are done. Then we move on to the next concept. Okay. All right. What we do is we take a 5-minute break. It's going to be a short break. We meet at 9:15. It's 9:11 right now because I have 2-3 important concepts to be covered with questions. So we definitely will need some time. I have to wind up by 9:45, 9:50. So 5-minute break. Quickly we go and we come back. Okay. Yeah. Fine. Okay, guys. So let's proceed with this with the remaining part. Now, major two things are left. One is a fresh thing which you can go through it right now. See, sometimes companies give option to the employee. Okay, companies give option to the employee. What option? If you want, you take equity. If you want, you take cash. See, we saw two types of share-based payments. One was stock options, where employee would get only shares. The other was SARS, where employee would get only cash based on price movements. So these are two different instruments. There is a third category of instruments, which we call it as share-based payments with cash alternative, which we call as share-based payments with cash alternative. What does this mean, SBP with cash alternative? This means that the option is given to the employee. The option is given to the employee कि if you want, you recognize, you take cash, or if you want, you take equity. So what I am having is my option or my instrument which will be given. First was ESOP. This contained only share. The next was SARS, which contained only cash payments. The third is a hybrid, share or cash, option with employee, option with employee. So now what would be very, very prudent? See, I'm asking you a question. Think and answer. You have to record this. You have to record this. I have issued it. I have issued the instrument. Okay. I do not know what the employee will want. Employee can demand cash also. Employee can demand share also. You tell me what would be conservative, or what should you account this as? Should I account it as? I'm giving you two options. You tell me which option. Option A, option B. Should I account for it as equity settled with cash alternative, or should I treat it as cash settled with equity alternative? नाम क्या दोगे इसका, उसके हिसाब से अकाउंटिंग होगा. It appears both are the same, but the accounting, what will drive the accounting? Will I call it as A, equity settled with a cash alternative, or B, should I call it as cash settled with equity alternative? What do you think? From a prudence perspective, कंजर्वेटिज्म के हिसाब से क्या सोचोगे? मेरा एम्प्लॉय इक्विटी सेटलमेंट प्रेफर करेगा, मैं उसे कैश का ऑप्शन दे रहा हूं. और शुड आई थिंक कंजर्वेटिवली, मेरा एम्प्लॉय कभी भी कैश मांग सकता है, हाँ, बट इक्विटी ऑल्टरनेटिव भी दिया है मैंने उसको. सो व्हाट डू यू थिंक will be the accounting treatment? Option B or option A? You will obviously say that this is option B, that is cash settled with equity alternative. Okay, ये हो गया first question. All right. Now, second question. Think and answer. The fair value of an ESOP was suppose rupees 10. The fair value of an ESOP is suppose rupees 10. The fair value of a SAR is, let us assume, rupees 12. Is, let us assume, rupees 12. Okay, or 10 share maximum risks is, let us assume, rupees 8. You tell me, सोच के बताना, in the third category, will the fair value be lower than share? Will it be lower than SAR? So 4 options again. 1, 2, 3, 4. A, less than 8. B, 8 to 10. इस रेंज में. C, greater than 10. Or D, no relation to ESOP और SAR. अपना मनमानी चलेगा, कभी कम होगा, कभी ज्यादा होगा. What do you think? What do you think should be the pricing? Should it be lower than that of a SAR? Should it be between the range of a SAR and an ESOP? Should it be more than both of them put together? Or will you say no relationship? Think of it logically. Think of it logically. Okay. I'm making you think this because I want you to understand the logic of this instrument so that the accounting part becomes easy for you to handle. Okay. Tell me, what do you think? The pricing, the fair value of this option, it will be given in the question. You don't have to calculate it. Okay. These are just made up values. Okay. So don't think that ये value कहाँ से आ गया, क्यों आ गया, ऐसे वैसे. Don't think like that. These are just hearsay values. I just want you to think and tell me, will it be lower than the individual instruments or will it be higher than that? It should be between 8 to 10 is what all of you are telling. Okay. Harita has said, Tushar has said. What about the others? What about the others? Nobody else gave me the answer. Well, typically it falls in this category because you are giving something which is far more valuable. See, an organization gives only a share, only a stock option. That means that organization is issuing only a share. Another organization gives only cash, not a share. You are giving either of the two. Beta, tum choose kar lo. You choose aapko kya chahiye. So what are you giving? You are giving both the things and telling beta you choose. That means in essence, you are putting both the things on a platter for the employee, and the employee has to choose. What he chooses will be a deciding factor later on. But what is important to state is the fact that you are giving an option combined in a single instrument makes it more valuable than share or cash individually. Have you understood this part? Everybody is saying that it falls between 8 and 10, which is not right. You are, see, okay, let me put it this way. Let me give a simple example. Okay, you are a company and you want to hire a consultant. You want to hire a consultant for management accounting and for taxation Okay. You go to the first firm. That is a firm which does only management consultancy services, but does not give any tax services. The second firm offers only tax services as part of its portfolio. It does not do anything else. Okay. There is a third firm which gives you both the options. बेटा तुम चूज कर लो तुम्हें क्या चाहिए, हम तो दोनों दे सकते हैं. So obviously, which firm will charge more? It is the third firm because that is what is giving you a choice. That is what is giving you a choice, right? So in a similar manner, in this case, the fair value, see, don't take this as the base, but what I want to tell you is the fair value of these instruments will typically be higher than a standalone ESOP or a standalone SAR. That is what I want to highlight. The fair value of this will be higher than that of a standalone ESOP or a standalone SAR issued by the same company. Okay, it will be higher than that. So this was what was the point. Now we'll look at how the accounting is done with the help of an example. Okay, we'll look at how the accounting is done with the help of an example. This example will be will take the things to the next perspective. You will be able to understand it clearly. Okay. Which example do I take? Okay, I will be taking this case, that is a question from your study mat itself. This is page 5.5051, illustration 6. Okay. 5.5051, illustration 6. Okay. So this is the question. I hope you can see the question. Okay. Tata Industries issues a share-based option, okay, to one of its KMP, which can be exercised either in cash or in equity, and it has the following features. Number of cash settled shares is 74,000 with a service condition of 3 years. Number of equity settled shares is 90,000. Conditions: service is of 3 years and restriction to sell is of 2 years. The fair value, equity with a restriction of sale for 2 years is 115. Fair value at grant date is 135. Fair value for each of these years is 138, 140 and 147. Pass the journal entries. Okay, so this is what is given to us. Okay, so if I opt for cash, क्या लिखा है इधर? Cash settled shares. I am getting how much? I am getting 74,000. I am getting 74,000 cash settled shares. Okay. I am getting 74,000 cash settled shares. Okay. Now, if I opt for equity, if I opt for the equity option, I am getting 90,000 shares. I am getting 90,000 shares. Means what? This is 74,000 SARs. This is 90,000 ESOPs. This is 74,000 stock appreciation rights. This is 90,000 stock options. जिसमें आपको shares मिलेंगे. But the problem with this stock option is they come with a restrictive condition. That means for 2 years you have to hold them. You cannot sell them. They come with that restriction. They come with that restriction. So how the standard views this is, you are allotting. Now please pay attention. Okay. I am rushing through, but I think you should be in a position to understand. You are allotting 90,000 shares. Am I right? Yes. 90,000 ESOPs, equity settled shares. These shares are going with a restriction of 2 years sale. Matlab, once you get the shares for 2 years, you cannot sell it off. That means 115 is going to be the fair value of the stock options on the grant date. 115 is going to be the fair value of the stock options on the grant date. So 90,000 into 115, the fair value of shares allotted is 1,03,50,000. Up till now, is it clear? Yes. Up till now, is it clear? Yes or no? Is it clear so far? The fair value of the equity options which you have given is worth 1,03,50,000, which is basically 90,000 into 115. Did you understand? Yes. Namrata, did you follow? Harita confirmed. Vidit, did you follow? Shriram, all the others, Nidhi, Asha, Panu, Viraj, Tushar, did you guys follow the first part? What is given is an equity option whose value is worth 115. So into 90,000, you have given something worth 1 crore 3,50,000. There is another thing which you have given. What is that other thing? Sir, that other thing is 74,000 rupees worth of stock appreciation rights. 74,000 number of stock appreciation rights. What is this 74,000 stock appreciation rights? This is giving the employee the right to exercise and get cash. The right to exercise and get cash. Okay. So when you are getting the right to exercise and get cash, अरे भाई cash तो free है. Free means what? Free to use. I mean to say that free to use. Do you think that there is any restriction on the cash? Do you think the company can say, I will give you SAR, but you will not spend that cash somewhere else? Can the company do this? Arey, how can the company tell you not to spend the cash? You will say, Mera cash hai, you give the money to me, I will spend wherever I want, whenever I want. How can you put a restriction on cash which is given to me? You cannot put a restriction on that. You can put a restriction on shares you allot because shares belong to the company. But the stock appreciation rights is a mere cash allotment which is made to me on which there is no restriction. And that is why the fair value of the cash portion is always going to be higher. The fair value of the cash portion is always going to be higher compared to that of the equity portion which is given with restrictions, compared to equity which is given with a restriction. You cannot have free equity, free cash and restricted equity with the same fair values. वो possible नहीं है. Okay, because equity in this case has come with a set of restrictions. Equity has come with a set of restrictions. So therefore, when you look at the pricing of the cash settled shares, that is the SARs, that is the stock appreciation rights, that is going to be 135 rupees into 74,000. 135 into 74,000. So this comes to fair value of the SARs is 99,90,000. 99,90,000. Have you understood this? Have you understood this part? Yes. Have you understood this? Bolo. So far, did you understand this? Quick. Did you understand this 99,90,000? Yes. All right. Now, look at what is given. Look at what is given. Okay. I have given an instrument. I have issued an instrument. Equity value of that is 1 crore 3,50,000. The SAR value of that is worth 99,90,000. The stock appreciation right value of that is worth 99,90,000. Sir, add kar do na donon ko. Hari, can you add? Are you giving both? Are you giving both? Answer is no. You are telling, तेरे को कौन सा भी एक मिलेगा. You will either get equity or you will get a stock appreciation right, or you will get a stock appreciation right. आपको दोनों नहीं मिल सकते. You will not get both of them. You will get either of them. So one thing is for sure, I cannot add them and say that this is my total employee benefit expenses. वो जरा सर गलत है. That is absolutely incorrect. What you can say is, come back to my question. I asked you, is it equity settled with a cash option, or is it cash settled with an equity option? What would be the conservative approach? I had asked you the question when I introduced this with you. That time you may have felt, sir, ye kyun pooch rahe? Sir, isiliye pooch rahe the, because now it is time to apply that. All of you said that this is a SAR, that is a cash settled instrument with an equity option. So what will be the value of that equity option? The value of that equity option will be the difference between the equity value of 1 crore 3,50,000 minus 99,90,000. So this gives me how much? This gives you 3,60,000 rupees. This is the worth of your equity option. This is the worth of your equity option. So basically, if I have to tell, sir, how do I define the instrument which I am giving? It can be defined as a cash settled share worth 99,90,000 with an equity option worth 3,60,000, thereby bringing the total worth of the issue to 1 crore 3,50,000. Is it okay? So don't make the mistake of saying it is 1 crore 3 plus 99 lakh. You are not issuing both. You are issuing only one of them. The option of that lies with whom? The option of that lies with the holder of the instrument, that is your employee. So therefore, subtract this and you will get the worth of the equity option. You will get the worth of the equity option. So what is the actual nature of your instrument? It is cash settled to the extent of 99,90,000 and an equity option of 3,60,000 and an equity option of 3,60,000. Just hold your patience. Don't say that, sir, उसने equity मांगा तो वो तो बहुत ज्यादा हो जाएगा. वो तो exercise के time पे आएगा. That will come at the time of exercise. वो हम देखेंगे. This is just for the purpose of making the entry in my books of accounts. Why do I do this form of entry? Because I need to be conservative to the reader of my financial statements. I cannot say वो equity ही मांगेगा. There is no such reasoning ना. वो कल को उठ के cash भी मांग सकता है. So I have to recognize the worst possible scenario. So therefore, I will be booking a cash settled liability to the extent of 99,90,000 and an equity option of 3,60,000 separately. So now coming to the accounting, okay. See, SARs have to be stated at their fair value every time, no doubt about it. So is the fair value given? Yes. You are given 138, 140, 147. So now, how many options are given? Options means this is stock appreciation rights. 74,000, 74,000, 74,000. Into what is the fair value? 138, 140, 147. There here, 138, 140, 147. Okay. Now, this is the total fair value. Proportionate expenses. This is based on time period. So, 1 साल बीत गया, 2 साल बीत गए, 3 साल बीत गए. Proportionate expenditure. This is cumulative. Less what is already recognized. First year, nothing was recognized previously. Second year, we recognize this. Third year, we recognize this. So, we are left with amount to be expensed in the current year. This is in respect of the SAR. In respect of the SAR. But sir, I'm giving only stock appreciation, right? No. You are also giving an equity option which is valued at 3,60,000. So that will be apportioned on a straight line basis. Uska to revaluation nahi hoga. There won't be any revaluation of that. So 3,60,000 divided by 3. I will spread it as 120, 120, 120. So the total expense that you are going to book is 35,24,000, 36,22,000, 40,91,333. Have you understood this part? Have you understood this? Bolo yaar. Please tell me. Have you understood this? It's getting a little fast, but just strain your minds. Give all your focus on the session. Yes. Are we able to follow this part? Yes, Vidit has confirmed, Janvi has confirmed, Harita, Nidhi, did you guys follow? Yes. Namrata, Vignesh, Asha, Panu, Namrata, और कौन है यार? Whose name have I missed? Shriram, I think he has done for the day. Yes. Are you able to understand? Yes. All right. Clear. So now, what will be the journal entries to pass? Sir, ये तो मेरा expense हो गया. Employee benefit expense account debit. To SBP reserve. 1,20,000 will go to the SBP reserve because this is the equity element in the option that you have given. This is the equity element in the option which you have given. So 120 will go there straight away. Okay. The other side, you are going to have the balancing figure as the share-based payment liability, which is this figure, 34,04,000. SBP liability. Same goes for year 2. Same goes for year 3. So is it okay? Equity is calculated on this price. Equity price with a restriction, this 115 into 90,000. This is the price per share. This is the price per share. Okay. Namrata, please watch it later on. Don't miss out the session. Okay. Because it's critical. Okay. This is the last critical part. The remaining 2 are not so critical, which I have to do it. Okay. So ye ho gaya mera accounting. That is done on 115. Okay, Tushar. But the option value is worth 3,60,000. The option value is worth 3,60,000. Okay. All right. Now the next part is, that is what I'm telling. How did I get 3,60,000? I valued this at 74,000 at the rate of rupees 115. And this is 90,000 at the rate of rupees 135. Kya tha wo? What was it? 135. Sorry. My mistake. This is 90,000 equity settled shares, na? 90,000 at 115. And this is 74,000 at the rate of rupees 135. Don't say that 360 is at what value. 360 is not at any value. This is just the equity option that is there. This is just the equity option that is being accounted. It is just to show the reader that you have not issued only equity. You have not issued only SAR. You have issued a combination of both. When we do the exercise, at that point of time, you will be able to understand the treatment. Okay, so let us just come to that part. The expense part, everybody has understood for the 3 years. Now we proceed to do the exercise. Okay, what they have said, pass the journal entry. So let us assume that the cash alternative is chosen. Cash alternative means cash kitna milega? 1,08,78,000. 1,08,78,000. So the entry will be SBP liability account debit to bank. SBP liability account debit to bank. This becomes 0 entirely. You take the total of this 1, 2, 3. It comes to 1,08,78,000. That is being paid in cash. So the SBP liability is extinguished. The SBP liability extinguished. Okay. Then the SBP reserve, which you have calculated as a difference, because that is the way you do it. You cannot do it through any other manner. That is the way you will be doing it. So therefore, the 3,60,000, now the employee has opted for what? The employee has opted for cash. If he has opted for cash, usko equity nahi milega. He is not going to get the equity. and if he is not going to get the equity, I cannot keep the SBP reserve hanging. I have to transfer it to the retained earnings. I have to transfer it to the retained earnings. So this is the entry that will be passed if the cash option is chosen. If the cash option is chosen. SBP liability debit to cash bank and SBP reserve account debit to retained earnings. You transferred the reserve to retained earnings and that takes care of the workings. Coming to the next one, equity alternative which is chosen. Equity alternative which is chosen. If the employees have chosen equity alternative, then remember liability will go away because now you don't have to pay this liability. The employee gives up his liability to get shares. See, it is not consideration कि भैया मैंने cash दिया और मुझे equity मिल गया. No, I am giving up a liability. I am surrendering my liability. I am surrendering what you have to owe me. In return, you give me the equity. It is similar to, in a crude sense, you would have done redemption of debentures. What is, conversion of debentures. What is conversion? You give up the debenture liability. In return, you would get equity shares. Similarly, I give up my right to get cash. In return, I get equity shares. So the entry will be SBP liability account debit, SBP reserve account debit 3,60,000 because that also will be utilized to equity share capital as well as securities premium. So this is the entry that will be passed if the equity alternative is chosen. You are surrendering your liability. You are surrendering the SAR. In return, you are getting your equity. So their consideration for the equity option, in all the cases so far, cash would be paid. Yahan pe cash is not being paid. Here you are surrendering the cash alternative and getting equity shares in return. So that is how you will be viewing it. Okay. Acha, in this case, there is just one small thing which I have to point out. See, upon equity alternative chosen, this is the entry which is passed here. Okay, share-based payment liability to share capital to securities premium to share premium, and then they have taken SBP reserve to retained earnings. Okay, I had discussed this in the previous class. We have made a note of this also in the class which is coming. Okay, this entry per se, as per Ind AS 102, as per IFRS 2, this entry is not wrong. This entry is not wrong. Please hear my words. ये entry गलत नहीं है. But a better presentation will be by saying that SBP liability debit 1,08,78,000. SBP reserve debit 3,60,000. To equity share capital 90 lakhs. To securities premium कितना होगा 1,08,78,000. 1,08,78,000 plus 3,60,000 minus 90 lakhs. So securities premium, how much will go? 22,38,000 will be recorded, which is basically the total of these two figures. See, what the standard tells is when the options have lapsed or when the options have exercised, any balance in SBP reserve, you will have to transfer it from one component of equity to the other. That is the standard definition which is there. Transfer it from one component of equity to another. Now, retained earnings is also a component of equity. Securities premium also is a component of equity. So that is why I say that this entry is not wrong strictly by reading IFRS 2 or Ind AS 102. But if I apply the Companies Act, I am issuing 1,38,000 and therefore the differential should go mandatorily into securities premium. So nothing wrong in this answer. I again repeat, nothing wrong in this answer, but better financial reporting would say that instead of retained earnings, transfer this also to securities premium. One, Companies Act requires any excess received above the face value to take it to securities premium. Second, if you take this securities premium, if you take the SBP reserve and transfer to retained earnings, then the employee, the reader of financial statements बोलेगा यार इसमें भी सेम एंट्री है, इसमें भी सेम एंट्री है, here the equity option is lapsed. Why? Because you took the cash alternative. यहाँ पे कौन सा lapse हुआ भाई? What is lapsed here? Nothing is lapsed here. You exercise the equity option only, no? तो फिर how am I recording this? How am I recording this? ये गलत है. Okay, so this may lead to ambiguity between in the reader of financial statements minds, but nevertheless, it is correct as per Ind AS 102. There is no problem. But what I was responding is from a Companies Act perspective, it would be a better presentation to take it to securities premium. The reader of financial statements will then have no doubt in the mind because entire SBP reserve goes to the premium and SBP liability also is divided between securities premium and the share capital. So it is absolutely clear that equity alternative has been chosen. Is it okay? So based on that, I gave my opinion, but I have also written that in the study module, jo change hoga, the new ones which will come. I have given my opinion. Let us have a look. Okay, some people say that why will I transfer SBP reserve to premium? Because premium is not a free reserve like retained earnings. If I transfer to retained earnings, the distributability of that amount is retained. But we are not looking at distributability. We are looking at specific over general. So that was the reason I would prefer to take it to securities premium. Okay, so this is how you will do the accounting. You can do any of the things. Option is given in the fresh module. Okay, so this takes care of the question as well as SBPs with cash alternative. Okay, ye ho gaya, group SBPs are done. Now we come to just the other two cases. That is, one is performance conditions. There are two performance conditions. One is a non-market linked performance condition. It is very simple. It is just like your service condition. Only thing is, at the end of each year, you have to estimate whether the performance condition will be met or not. For example, your options will vest if the turnover in the 4 years will reach 500 crores. So at the end of each year, you estimate whether in the future my turnover meets 500 crores or not. If yes, the options will vest. If no, the options will not vest. So that is how you do the accounting. It is similar to how we saw how many employees will continue till end of the year. Do the accounting. Next year, again estimate, do the accounting, subtract the previous period's expenses to get expenses of the current year. Same thing is done. Only thing is here you are estimating that the performance condition may be fulfilled, may not be fulfilled. That is the only thing which you have to do. So those things you have already done in your IGAP also. So that is why I will not be taking you through those questions. You can refer them here. If your performance condition is a market related condition, then in that case, the market related condition should be ignored because that would have been factored while determining the fair value of your stock option. So market related conditions, ignore. Why? It's included in the fair value of the option at the grant date. And since it is included in the fair value of the option at the grant date, you don't have to consider that. separately. So market related conditions ignore. Performance related conditions, at the end of each year you will have to estimate whether it has vested or not. So therefore that is the way you will do the working. Please go through these questions. You should be in a position to understand and solve them by yourselves. Okay. Coming to the last part, that is the modifications and cancellations. When a stock option plan is cancelled, okay, cancellation means a breach of contract. So a breach of contract means typically employees, when they are given a stock option plan with a cancellation period, then that cancellation with a vesting period for say 3 years, 4 years, or a performance condition, and the company breaches that, it cancels the options, it means the employee is free right from that. The bondage is gone from the employee's head. That means the options, the vesting period is shortened, and because of the breach of contract, a compensation becomes due from the company to the employees. See, if the vesting period is 4 years, employees have served for 3 years, end of the 3rd year, the options are cancelled. Then employees would say, we stayed till 3 years because you were giving us an option in the 4th year. Abhi aapne humko cancel karke, you have made us a scapegoat because we are suffering because of your cancellation. So what will happen is the employees become free from the period of cancellation. So vesting period gets shortened. You recognize the entire expenses which you were accruing, and any compensation that is there, to the extent you have balance in SBP reserve, you meet it out of that, and whatever extra is there, you will take it to the profit and loss account. So that is all that is there about cancellation. Modifications, in between the period, there may be an actual modification of the stock options. Okay, go through these 2 questions, please. It's my request. I don't have the time to run you through the questions because we spent a lot of time in discussing the concepts initially, but I'm sure you will be able to follow. The modification of an option is an actual modification which results in a benefit to the employees. Any modification which is to the detriment of the employee has to be ignored, because that will never fructify, it will never materialize. So modifications detrimental to employee will have a fair value 0. You ignore that. Modifications which benefit the employee will increase the fair value of the options. So on the date of modification, you will recognize the incremental modification or incremental change that happens, the incremental increase in fair value, incremental fair value change over the remaining period. You will compare the fair value of the revised option on the modification date versus the fair value of the original option of the original plan on the modification date. Compare both of them. The difference will be amortized over the remaining period of the options. So when there is a modification, original plan would continue as it is till the end. The revised or the modified plan, you will treat it as a separate option. You will treat it as a separate plan, and based on the incremental fair value, you will do the accounting of that over the remaining period till the vesting period, and then you would club the expenses of both of them together in the financials. So that is how you will do it. So my sincere request, friends, is to go through ESOP's modifications and cancellations separately. Okay. And if you have a doubt, you can reach out to me. Okay, you have the questions and you have the presentations. So please go through the presentation and the questions. Okay, 1 second. SBPs with cash alternatives we have discussed, and we have done these questions. Yes. SBPs among group entities also we have done. Okay, and we are left with modifications, right? I have modifications written somewhere for you. Cancellation or settlement of the grant. See, it is an acceleration of vesting. Okay, and payment to employee, deduction from equity, excess is expensed. That means SBP reserve debited. Okay, you would have credited the SBP reserve up to that amount, whatever is the compensation, meet it out of SBP reserve. If anything extra, expense it out. Okay, so that is how you will do the accounting. Modifications, not beneficial, ignore. Treat as cancellation. Modifications to the detriment of employees, you will be ignoring. Okay, beneficial to employees, account prospectively. Okay, so that is how you will do the accounting. Okay, so this is all discussed. Okay, so please record this, and you will be able to understand. Okay, so you can reach out to me on I'll just give you the email ID on which you can reach out to me. You can give a question there. You can drop your question there. It will come to me, and then I will help you out with whatever doubts you're having. Okay, so please feel free to reach out to me, fr-final@icai.in. Okay, so you can just reach out to me on this mail ID. I get the queries regularly on this, and I will respond also. Okay, so please feel free to revert. That's it for the day. Then we shall meet again in the month of May. Let us see. Hopefully, I don't have any sessions in April. Once the May schedule comes out, we can see whether we have a chance to meet in the future or not. Okay, so with that, I close today's session. Thank you everyone for a patient hearing. Go through the sessions, go through the discussions, what I told you to go through. Reach out to me for any doubts that you have. Okay, I'm sorry I had to hurry up towards the end. It was not my intent, but I did not have the time, and I think I'll have to hurry up a little bit if I have to ensure you get the concepts right. Okay, so that's it for today. Thank you so much, and it was great being with you guys, and see you hopefully in the month of May. Okay, see you in the month of May. Thank you everyone. Thank you. Take care. Stay safe. Okay, thank you. Yes, all right, sir, class is done.